When a global credit ratings agency flags major structural shifts across our region, it pays to strip away the usual brokerage marketing and look at the raw credit risk. We are looking at an independent mandate focused entirely on balance sheet resilience, not on pumping up stock prices. If you are managing your own central provident fund or supplemental retirement scheme portfolio right here in Singapore, understanding these shifts is the difference between protecting your capital and letting it ride completely exposed. I have been dissecting this specific macroeconomic report all week because it maps out an immediate, unvarnished look at regional vulnerabilities. My job is to track what the broader market and credit analysts are saying before Iggy runs the forensic numbers on individual names. It highlights a critical tension. 4 major sectors are moving through major capital transitions right now, and the fallout has direct consequences for your investable cash, your household utility bills, or both. Let's walk through the data step by step to see exactly where your portfolio stands. Turning first to the gaming sector, macro revenues are rising across Singapore and Malaysia, driven by climbing visitor numbers and massive corporate transformations. The data shows that Marina Bay Sands completed its $1.8 billion multi-year reinvestment program in 2025. Meanwhile, Resorts World Sentosa, operated by Genting Singapore, is pushing ahead with its own 6.8 billion Singapore dollar master plan. And Genting Malaysia is racing to capture that exact same regional travel volume. But look beneath that premium glitter and you find 2 severe core tensions: an aggressive domestic share battle and global oil price shocks. Both of our local integrated resorts are upgrading simultaneously, which means they are about to fight over the exact same pool of premium international travelers with newer hardware. On top of that, while current Brent crude sitting between 72 and 75 US dollars a barrel provides a brief cushion, any sudden escalation in the Middle East will instantly drive up travel costs and dent consumer holiday budgets right when these properties need to earn back their massive capital expenditure. Moving into real estate investment trusts, commercial properties are facing structural delays across several global gateway cities. But Singapore and Tokyo are explicitly bucking this negative trend. Our local office sector remains highly resilient due to steady corporate tenant demand paired with very limited new supply coming onto the market. However, the overarching risk flagged by credit analysts is rising funding costs, because if commercial landlords face spiking borrowing costs while property revenues flatten, core credit metrics across the sector will rapidly deteriorate. The phrase limited new supply is doing an incredible amount of heavy lifting in this optimistic real estate narrative. While a supply crunch protects net property income on an aggregate level, individual asset execution across our local commercial listings varies wildly. You cannot simply buy the generic sector story and assume every property portfolio captures this tailwind equally. As retail investors, we must look past the averages and actively audit individual occupancy rates and tenant lease expiry profiles to protect our capital from underperforming assets. In the technology space, artificial intelligence expenditure is acting as a massive capital counterweight to broader macroeconomic slowdowns, offering clearer near-term profitability tracking than many traditional industries. This massive infrastructure spend is driven entirely by hyperscalers like Microsoft, Google, and Amazon, whose surging capital deployment is directly feeding the semiconductor and server supply chains. Yet this sector carries 2 vital structural vulnerabilities: incredibly low near-term visibility on actual corporate monetization of AI at scale, and highly elevated energy costs. This entire digital infrastructure cycle relies on a single aggressive assumption: that data center development can run far ahead of proven corporate revenue. Right now, tech giants are spending on the expectation that commercial software monetization will eventually catch up. If that spending pace breaks, or if corporate clients begin slashing their software experimental budgets, hyperscaler spending will slow down dramatically, testing the aggressive rental assumptions and premium real estate valuations currently priced into specialized industrial portfolios. Turning to utilities, energy security is forcing major policy adjustments across the region as economies ramp up coal generation to combat natural gas shortages. This leaves gas-reliant markets like Singapore deeply vulnerable, as we import nearly all of our natural gas to fuel domestic electricity generation. Any prolonged Middle East conflict poses a direct operational threat, forcing local utility providers to buy expensive spot market fuel, which instantly compresses corporate margins or passes the entire financial burden straight down to end consumers. This utility risk is the one that hits household cash flow directly, representing a far greater threat to daily life than standard equity portfolio swings. For retirees drawing a fixed monthly income from a supplementary retirement scheme account, structural increases in power costs eat away at actual purchasing power far faster than core inflation figures imply. The second quarter 2026 tariff already advanced 2.1% to 27.27 cents per kilowatt hour before tax, and we must watch the Energy Market Authority website closely for the upcoming third quarter release. Putting these four areas side by side, a clear macroeconomic pattern emerges. Every single sector is a concentrated bet on a current trend continuing indefinitely. Gaming assumes tourism expands fast enough to support 2 upgraded mega resorts. Commercial real estate relies on limited supply to shield rents, and technology bets that hyperscalers will keep pouring billions into AI before it even pays for itself. Meanwhile, utilities enjoy no luxury at all, leaving every single household fully exposed to global energy shocks. In this volatile macro environment, the critical line separating a genuine corporate sanctuary from a name that quietly turns into a portfolio drain is regularly decided in a single trading session. Waiting for traditional delayed commentary means you are acting on old data. By the time this depth of financial analysis trickles down to a free subscriber, the specific entry window identified has already opened and in many cases closed completely. This is precisely why Iggy's Elite Investors matters. For $9 a month, which is less than a basic kopi and kaya toast set at Raffles Place, members get 0-day access on Substack and YouTube, full Red Zone watchlist, and institutional-grade cheat sheets. While credit ratings agencies map the shifting macro terrain, a rising tide does not lift every single hull in the harbor. A broad sector tailwind never guarantees that an individual listed company will execute its business plan or successfully protect its balance sheet. The macro data shows us where the structural pressures are building, but it remains our absolute responsibility to check individual corporate balance sheets to ensure management isn't taking reckless risks with our retirement capital. That's the systematic path forward, moving from broad macro signals down to strict individual company verification, auditing debt levels, occupancy stability, and interest coverage ratios before committing any capital. I'm Angela, bringing you the market and analyst context before Iggy runs his forensic numbers. If you want his full breakdown before the free version drops, 0-day access on Substack and YouTube, full Red Zone watchlist, and institutional-grade cheat sheets for $9 a month, link in the description. The window is already open. In this macroeconomic environment, the gap between a secure yield and a structural trap closes incredibly fast. That's exactly what Iggy's deep dives are built to catch before the market moves. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.